I'll also share a 400x success story and explain why only a few investors actually achieve this kind of growth. As a stock market investor, you must have felt the urge to sell everything when your investments reached a big number, a certain value, just to protect it from the loss. In this video, I'll show you why this fear is actually an opportunity. You must have hit a point when you've become uncomfortable with the amount you've invested. You start checking your portfolios more often. You start booking some profit just in case the market crumbles. That number could be 1 lakh, 5 lakh, 10 lakh, or even more, maybe a crore. So the thing is, every investor, no matter how experienced he is, has a threshold where he starts to feel the pressure to sell or to do something because they feel like they are risking too much. Their mental limit is where investing starts feeling risky rather than an opportunity. That's the personal threshold limit, or PTL, a point which is unique to every investor where the fear overpowers due to the amount at stake. So unless we are able to expand this PTL, it becomes a big barrier in compounding wealth. This is the biggest challenge in growing wealth. And this PTL is tied to our risk tolerance score and our net worth. So for some, 1 lakh in equity looks potentially very large and he feels risky. Whereas for others, only after reaching probably 10 lakhs, he might start feeling that pressure. So there is no right or wrong threshold. It's about understanding one's own comfort with risk and volatility. Now let's say your net worth is 2 crores, which means you have a flat, you have some land, fixed deposits, you have some loan, all put together net you have a 2 crores net worth. Now let us say your demat mutual funds all put together is 4 lakhs in equity. When your equity valuation crosses 4 lakhs, you're not very comfortable. You try to time the market. You now feel that the markets have gone high, you must sell. Then all of a sudden you feel you should start buying. All this behavior indicates that you've crossed your PTL. And look at the insights in this behavior. Your equity is just 2% of your net worth of 2 crores. How does it matter if your portfolio crashes by 20% or if it goes up by 20%? It's not going to impact your wealth creation. If you lose 20% of stocks or mutual funds, it's like losing 0.4% of your net worth. Similarly, if the portfolio goes up by 20 or 30% also, it's going to be a very small impact to your overall wealth increase. So, when the equity investments are only a fraction of your overall wealth, fluctuations in that portion, be it 20% or 30%, will have little impact on your overall personal wealth. Yet, if someone's personal tolerance limit PTL is low, these fluctuations can trigger a discomfort and lead to very reactive behavior, like timing the market, buying now, selling tomorrow. So if equity has to contribute to your wealth growth, then you'll have to expand your PTL. How do you increase your PTL? First, the reason why PTL exists. This is due to a concept called loss aversion in behavioral psychology. In simple words, loss is more painful than the pleasure of gain. This fear can hold us back from letting our investments compound. Let me tell you about a real life example. Let's say this investor's name is Rajesh. Rajesh shared with me his 5 lakhs invested in an equity mutual funds portfolio. He was comfortable while the portfolio was growing steadily. But as soon as it reached 7 lakhs, he began feeling uneasy. He would call me every few days and he was worried about market going down. And he kept asking, should I book profit? Should I sell? Should I do something? What if market crashes? So when I asked him why he was feeling that way, I figured out that 7 lakhs was a big amount for him and he didn't want to lose it. So Rajesh's threshold was about 4 to 5 lakhs. And beyond that, he started feeling nervous about holding so much in equity, even though he trusted long-term compounding. So we reviewed his financial goals and he was reassured that volatility is a part of investing. This made him feel more secure, and I suggested that he shift a small portion, 10%, into debt fund so that he can protect some profit. For the rest, we could set up a simple rule to review and not to react regularly to market movements unless something major happens. Over time, this approach helped him stick with his investments without getting into fear. What I'm emphasizing is that his limit was very unique to him and was a factor of his financial situation, his net worth, and how much of that is in equity and his psychology. So, rebalancing is key here to reduce your worry. Moving a small portion of the profit into safer assets such as arbitrage or debt can help you grow without sacrificing equity participation. A few practical tips to fine tune your investment strategy and align it to your comfort level or your PTL. So, if you have a smaller PTL, whatever that number is, for some it could be 1 lakh, for some it could be 5 lakhs. So, if you have a smaller PTL, you might want to invest in conservative funds with a larger share in debt funds. This conservative approach will help you get comfortable with equity and build confidence without taking too much risk. Now, if you have a higher threshold, higher PTL, could be 20 lakhs or it could be 50 lakhs, there is a scope to get aggressive. You can start setting up rebalancing rules. Try partial profit booking. Use core and satellite strategy. This way, you have a stable portion of your portfolio safe, while a smaller part is always geared towards growth in equity. But the key is to avoid the urge to book profits too soon. Automating, like booking profits through SWPs or STPs, rebalancing regularly instead of panic selling, and setting your own rules for review can help manage the temptation to keep selling very often or react to every market move. Another solid option is to invest in low volatility equity funds. They will cushion big market falls while also letting you ride the equity growth wave. So all these steps are all about making it easier for you to handle the emotional ups and downs of equity investing, expanding your PTL, and ultimately this will increase your threshold to bear volatility. The final reality check is that everybody enjoys big rewards in equity. But take a look at Nippon Growth Fund, one of the oldest funds. It has grown 400 times over last 29 years. The original NAV of this fund was rupees 10. It is now 4,000. But how many investors actually stuck with it for their entire journey to create wealth? Hardly a very few. Probably hasn't seen so much wealth growth from this fund. Why? Because things get in the way. For example, market cycles, economic downturns, personal financial needs, and most of all, our own behavior. Many people panic and sell during downturns, or they get impatient during stagnant long periods. So that's why wealth from equities tends to be realized by a very few people. Equity markets are not for all. At least the wealth from equity markets go only to a few if you look at the history. On the flip side, remember, because of the greed and fear, there is always risk of falling into dubious schemes, fraud promoters. So being cautious is also equally important. If you found this content helpful, please don't forget to share it with your friends, like it, and subscribe to this channel.